Hi, this is Troy Rasmussen from Ag Perspective. I'd like to give you some idea of what we're thinking for 2016 and also address the 2015 crop that's in storage. First, old crop targets. Let's get those out right away so you're aware of what's going on. We're looking at points on the chart that we like at both 380 and the 390 to 395 range to move old crop corn. Basically, by the time we get to 399, we'd like to be 100% priced. There is merit for that 390 to 395 with some consolidation in March futures in that zone. I do believe it will be a challenge to get through 380 in the short term. We'll see how things play out there. In beans, 895 is very achievable. Matter of fact, as of today, we aren't that far away. We know that quickly with a weather issue in South America, we could be to 910 and 925. With the current fundamental picture, I'm more of a fan of being priced out by $9.10. If we're more concerned about a weather issue, pushing price another 50 to 60 cents, which is possible if South America has a minor scare, a guy would be better off buying a few call options to give him upside versus waiting for that 950 to 970 region. New crop corn targets. We'll get started at $4, and that's more of a psychological thing. There is one little small hiccup on the chart that could be a target there, but a good target is more like 420. Matter of fact, that's the one I prefer using. 445, on the other hand, is an upside objective that, in my view, probably is a weather-related issue that gets us to that point. 420, achievable. I want to get quite a bit done there. I'd like to get 75% hedged. I'd like to move very, very aggressively in getting floors put in below us at that level. Now, that doesn't necessarily mean I'm willing to sell in upside away. It means I'm willing to put a floor in to have a safety net in case we never get a weather rally. Beans. Those targets are 925, 940, and 980. Let's start and work backwards on this one. The 980, very good target, but again, that target I view as solely weather driven. That could be a deep in July or August type of sales point based on how our summer growing season goes. 940, very achievable, looks solid by the chart. 9.25, I'm not as excited about, but considering a large crop in South America, we may be forced to get more excited about 925 and move at that point. But for today, I'm looking at 940 to try to get 75% of my crop hedged to get a floor under it. So that's the overview of old crop and new crop. Now let's dive into a little more detail here and take a look back as to what 15 offered us and how we can learn from what took place there to price the rest of the crop and look forward to 16. We all know we have a market that is fundamentally in a position to limit upside. And in years like this, inherently we see a minimum of 2 opportunities to price a crop. This is a continuous corn chart reaching all the way back to November and December of 14. We had an opportunity that I've circled by the chart. That took place in that 412 to 420 range. That was prior the final report in January. From there, we fell, then we bounced sideways to lower, generally speaking, all the way out into mid-June, when finally the weather story stuck where we just had too much rain. Funds were excessively short. They began a panicked covering, which pushed price to our ultimate contract high just around 440 versus the March futures. At the time, that continuous look back to D15 futures would have been a high of about 452. Now the interesting component there, as you can see, this rally started from the low, reached the contract high, returned to the contract low, all in a matter of 5 weeks. Now, looking forward, I cannot emphasize enough how important we see it to move swiftly and in large percentages if we have any type of opportunity to lock in or put floors in at levels that are near or above break even. And this is an example why. The bean year traded very similarly. We had an extended window between October and January to try to get pricing done or get floors in. Then we started a steep decline, and you can see that obviously a good crop out of South America in the field growing during the months of February through May pushed us sharply lower. We began that short covering rally that was based on U.S. weather. Then we fell back to new lows after we proved to the market the beans are there, or they look to be there. So since then, we've done nothing but consolidate, set a new low, and end up in the middle of the range for the most part, between 850 and roughly 920. So going forward, it's pretty important that you can see we're in such a steep downtrend. If we get an opportunity back above that 920 to 940 range that I mentioned earlier, we want to get hedged up. Let's take a look at the way the final 2015 balance sheet played out. In corn, the USDA lowered our overall yield from the December estimate. They backed it down almost a bushel. That helped. They left acreage unchanged. The concerning issue is you can see the continued decline or the tendency to lower exports on a monthly basis. We lost another $50 million off the balance sheet. That actually increased stocks to a 1.8 billion carryout. That said, you can see the good news in this report is the fact that we saw a decline in world ending stocks. That seems to be one element of what's holding corn price intact today. For some reason based on usage, possible yield estimates that have been off, whatever it may be, you can see that in a 2-month period we've declined slightly. Now obviously we're well above our lows of 187.8 million metric ton, but the tendency is to hold steady or decline here. So we need to be optimistic about that. Look forward to possibly some more declines as we go through the year. Now, this is an interesting chart that I stumbled upon. It's Illinois grain stocks. In the month of December, overall you could see we're actually down slightly. We're somewhere near that 1.8, 1.7 range overall. You can see that on-farm stocks are slightly lower than last year. So in the grand scheme of things, looking at what corn is still out there, there's plenty out there, don't get me wrong, but not quite as severe as last year. This will limit our ability to rally, certainly, but I don't view this as much different. It is not alarming versus going back to 2007, 2008, when we were nearly at 2 billion bushel of inventory. All told, this is not horrific the way I view it. January bean report came back with a lower planted acreage number, a lower yield estimate, and a lower export projection, but not dramatically lower from the export side, which was enough to cut ending stocks to 440. That surprised the trade a little bit and has firmed us up accordingly. But you can see that there was a more significant decline in world ending stocks. I believe it was about 18 months ago that we estimated as a community that we could be well into the 95 to 100 million metric ton world ending stock carryout by this time. That has not happened. Usage worldwide has increased. Production estimates have been wrong, whatever they may be. The USDA has us in a pretty decent downtrend over the last several months. That's good news. Let's look at what's worked. This slide I dug out from years gone by, but it's a great illustration of the time frame we're in today and how we need to trade this. From 09 to 12, we could postpone sales. You know, basically you were just kicking the can down the road until harvest and pricing it. It was an easy time to make money. It all worked that way. 13 and 14, we started that steep decline off the highs from 12 after the drought. Instead of setting targets, we should have been just selling with stops. At least we would have got knocked into sales at decent levels as the market declined. In 15 and 16, we see number one, 16 offering opportunity only on weather scares, and on 15, essentially the same thing. So when we get an opportunity to get floors in, we need to move quickly. Now, in an ideal world, there's a certain timing I like to maintain. I call that my risk calendar. I like to be peeling risk off every single day that goes by. So here's how I view that. Here's some basic targets. In January, I like to be about 50% hedged if I can be. By the planning intentions report at the end of March, I like to get to 65. By the time the planners are rolling, ideally it'd be nice to be 80% hedged. And by the final acreage report at the end of June, I like to be 90% hedged. And finally, when we're reaching maturity of that crop, I like to get to 100% hedged. Frankly, we have not had that opportunity thus far. The market has not given us a chance to get at least 50% hedged by now. And as a farming community, we are vastly undersold old crop with nothing done in the 16 crop. Unfortunately, guys, the masses are generally wrong. Now, let's determine how much risk we have by asking ourselves these questions. How much grain do I have sold? None. As the community, for 16. As the farming community as a whole across the Midwest, there's very little to none done. Are we above or below break even? Or obviously we're below. Is price above fundamentals? Here's where I say we're below fundamentals, and this is why. Funds are excessively sold. Record short. You've heard this terminology before, but we are absolutely record short. And at this moment, by being or getting record short, they've driven this price into the basement. Do I expect a large acreage swing? Not really. I expect very similar changes to what we saw a year ago. Is the world and domestic carryout expected to climb or fall? Well, for the most part, we saw the recent trend is lower, but given a good crop in South America and an average crop in the States, we're probably going to increase carryout here in the States. Now, from a worldwide standpoint, I guess we can debate that for a long time, but for the most part, we've declined over the last 6 to 7 months. Unless we have a huge crop, we're probably going to be flat to climbing or increasing that level. Now, where does that leave our projections fundamentally for next year? Well, the USDA has plugged in 90.5 million acres in their outlook data. I disagree with that. We'll touch base on that as we move forward. But they also, now with the big acres, they have big exports in there. And frankly, with the level of the US dollar, that is just probably not going to happen. Things have to change. But that ended their year at a 1.75, a slight decline from last month's projections of old crop being at 1.8. So moving forward, obviously we will be focused on a yield, export demand, and thirdly, what are we going to plant for acres? Now here's the debate. Let's look at corn yield state by state. In the West, incredibly good yields. No question about it. Illinois, somewhat near average. Indiana, rough year. Ohio, rough year. Missouri, very tough. We know where the rain hit. The rain hit southern Illinois as well and trailed all the way up through Indiana and Ohio. Now, Informa is estimating we'll plant about 88.5 million acres. I tend to agree with them versus embrace the USDA numbers, because I think it's a matter of the West will plant what is fresh in their mind. They're saying, I can grow a big corn crop. I've done it the last couple of years. The East is saying, boy, my input costs are eating me alive here. I can't make 150, 160 bushel corn work under this scenario. So, what is the USDA basically going to use in their first balance sheet? Well, they're probably going to use a 172 trend line yield, and they're probably coming back close to 90.5 million acres. So, that number is going to be, that carryout number is probably going to be in that 1.8 range by their first balance sheet. On the bean front, 46.7 is what they used for a starting yield, and 1.8 exports. That export number, obviously a little bit high as we see it versus a year ago. That leaves us with carryout around 421, so in the very same range we're in today. This might come a little higher because I really believe, again, that yield 50 bushel in the East as a whole, I think we're probably going to see a few more bean acres than maybe we had planned. The rumblings I hear on the street are this. In the East, we're tight for cash. We had decent yields in beans versus our yield in corn. Let's plant the beans. Yes, we're close to 50-50, but the bias is even a little heavier than 50% in the beans for next year. So I expect those numbers actually in carryout wise to come higher. Again, the USDA is going to use a 45.5 as the standard trend line for this year. Now, what is the biggest thing that throws a curve in our marketing plan for the year? It's a weather scare. So let's not forget, a weather scare can take place. We've talked a lot of doom and gloom. Here's the thing that can push price beyond what we've planned for. Here's one article that was posted the Washington Post not long ago. And it states, in a nutshell, in years that are similar to last year, excessively wet, there have been 9 of those cases, and in 6 of them, we have cut yield 15 to 33 bushel below trend line. And you can see by the numbers, 74, 83, 88, 93, 2012, all basically drought years, what it amounts to. So we go from the wettest years and turn around and balance it. Mother Nature has a way of evening things out in time. Well, if you were excessively wet, obviously 6 out of the 9 years following, we were dry. Here's another interesting stat that seems very minor and overlooked. In 2012, obviously our drought year, Argentina had a drought as well. Production dropped 25%. And keep in mind, they're growing that crop from basically February to May. From January to April, during that time frame, U.S. beans rallied $2.50. We would be elated if we got a $2.50 run today, and completely, as a farming community, ill-prepared for such an event. Let's make sure when we do our marketing plan for 16, we're prepared for this. So here's how we started. I'd like to enroll 15% in accumulators at a given price, and I'll explain here in a minute. I want to sell with HTAs 15% by call options. Implement option collars through grain contracts. They can be done in brokerage too, but then we've got other issues that we'll discuss. But I would like to get essentially 75% of my crop protected. Here's how we want to do it. At 420, I'm looking at several accumulators that I really like. This would be on 15% of the crop. Here's an example of one. At 420, it's projected to start incrementally pricing on a weekly basis at $4.40 or 20 cents really above the current market at that point. The downfall is if we reach 365 at any point during the life of that accumulator, you're kicked out. Any sales that haven't taken place won't take place. That's the downfall. Secondly, on 11.25, if we're above 440, you've committed twice as many bushels at 440. So a double up. Now, I'm not a huge fan of double ups. I would love not to have double ups. The issue becomes, in order to get my 20 cents over my premium, to get corn priced at 440, I need to give up something. And I'm going to give up a little upside in this case. And I'll explain why going forward, because I'm balancing it out with another trade. So point is, in order to get that extra 20 cents, I got to give up something. Here's another one I like. This is a full quantity structure. It prices at 430, knockout at 365, but when you're knocked out, it prices everything at 418. That's good news, but you're giving up a dime up front to do that. And secondarily, now your double up takes place 10 cents lower at 430 as well. I'm pricing 6 of these currently. We're watching them on a daily basis. There's another one that I'm working on that I like as well. So when we get to 420, we'll be ready to go. We're bringing these to our guys saying, okay, this is the pluses and minuses. This is what we like. Here's how we account for this. Now, I mentioned earlier that in the case of a double up, I'm accounting for that through an additional trade. It doesn't necessarily mean it's additional, it means it's a balance. I'm also selling corn in an HTA at 420, but I need upside on that sale because I have limited upside on the previous sale. So I'm going to buy a 460 call for 18 with it, and now I get a 402 floor. Below break even, realize that, but have good upside with this trade. So obviously, we hope on the rally we can get that call option gain in value, add back to the sale, get well above break even, lock in some profit as we go. Now, another target out here, subsequent to the 420. If we get to 445, we want to price another 35% of our crop. It just seems like a no-brainer on the chart to get that done at 445. And again, now you're well above break even. Next move. This is the one where we want to put a floor in and offer upside to a degree. Options are a give and take. In order for me to get the best floor, I have to give something up. If I want a 410 floor, I have to sell away a little bit of upside, but I don't want to do that too close to the money. So with this trade, I'm putting the floor in at 410. My overall cost is a nickel, so I estimate my net floor at 405. The advantage is I can price futures inside this grain contract on a rally. My floor still stays in place. That's all fine and good because it's only going to cost me a nickel if all this expires worthless. But at least it kept me from making that sale until we reached my target of 445. The disadvantage, my top side, I can only gain to 480. Beyond that, I'm limited. I can't do a thing. I'm out on this 45%. But I have a lot of unpriced grain. I have floors under it, but I have a lot of unpriced grain that is gaining as well. So let's take a look at what this hedge looks like. I'm a visual guy. It's nice to see this sometimes. So here's how this looks. Break even's about 410. I estimate a crop insurance floor is about 330. Who knows where that'll end up? We'll know more in the middle of February on that. Jury's still out. If I buy the 410 put, that gives me a floor right at 410, less the cost. I would like to sell a 330 put to basically protect the range down to your crop insurance. Then I will sell the 480 call as well to get the cost down, but that limits our upside to 480. So you have a floor at 405 after cost. You have upside all the way to 480, no upside beyond that. Beans. We're going to sell 25% in HTAs. We are going to put an option collar on 50%, and we're going to buy long puts on 25%. Here's what the HTAs look like. At 940, 25%. We're basically buying $10 calls here to give you good upside for a cost of about 28 cents. There's a 912 floor. And obviously we are maintaining upside if we have that weather issue. We've got floors in place. We're leaning defensive, but we're in good shape planning for that weather issue if it were to come to pass. Again, I mentioned earlier in the presentation how good 980 looks on the chart. If we get there, I'm going to have to sell some. Sell another 25% at 980, just to put that in the back of your head for now. We'd probably add call options to that, but a lot of that depends on the timing of the year. We know that if it gets past, the first week of August in beans, it gets pretty tough to make money on call options. So we keep that in the forefront of our mind and make that decision as we get there. What brought us there? Is it that weather scare? And if we're in the heat of that, fine, you got to buy calls. If we're not, that could be a different story. The option collar. Buy a $9 put, sell an $11 call, and guess what? We got an instant floor. Floor cost about 20 cents, roughly at break even on your floor. The good news in all of that is you've got upside. But you know what? You can wait for a rally to take place, and hopefully you get to that 9.8 and get some beans priced at that level while maintaining a relatively cheap floor. If you had to just go out and do this straight up, it looks a lot more expensive. The bad news is we got a ceiling of 11 bucks. So, the message I hope to send on beans is this. Fundamentally, I'm more concerned about beans. Be quick to add your floors. As the cowboy says, shoot first and ask questions later. There are other things that we're concerned about moving forward here too, and one of them can be addressed as we go through the year. Are we asking ourselves these questions? Where are my floors? How covered am I? Have I accounted for any yield changes? That's preparing for seldom. Yield changes based on weather issues. What do I have at risk overall? Now, over a year ago, I developed a simple spreadsheet. Boy, I am not a spreadsheet guru, but I wanted a way to incorporate all the positions my guys had, whether it be on the board of trade, sales at the local elevator, sales with Ag Perspective, because we have our grain dealer's license and do grain business there, maybe even structured prices like accumulators, etc. So I developed the marketing risk assessment. It is a snapshot that accounts for several things. Number one, acreage and yield changes. I'm talking to guys, and as we go through the year, we're adjusting it accordingly. What I'm really after is, how many bushel do we have locked up for delivery? How many bushel do we have to deliver? What do I have hedged as a percent of my production? And at what price level is it hedged? So where's my real floor after my investment in options and positions, etc.? And lastly, how much upside do I have? If we're into a weather scare and I'm 96% sold with only 4% upside and my yield is shrinking, we're in trouble. This is a post-season MRA. He's got 96% of his crop with a floor under at 416, whether that's priced or whether that's hedged, somewhat irrelevant for this example, but he has upside on 4% of the crop because we're not necessarily trying to hit a home run for 15. We've basically secured price, we're moving on. But make sure you account for these things. It's critical to know where you're at, especially in a case where you have a weather scare and decreasing yield. So what's next? What do we do with all of this? How do we incorporate this? Well, these are the keys I see. We've now got to transition from having these defensive positions on or sales, and we got to turn it into cash. We got to manage the carry, we got to manage basis, maximize storage, and use our labor and trucking force at the proper time. That's where we touch Scott Stoller. In his presentation, he'll talk about how we can make that transition, because that's the important part. As producers, you're not just in business to grow a crop. You're in business to grow that crop to turn it to cash so that you can keep your operation gaining value, increasing bottom line every year. That said, please tune in for his will follow mine. Thank you very much. It's been a pleasure to get to bring this information to you. I hope it helps in any way to your 2016 production season. Give us a call at any time at Ag Perspective. Thank you.